Lehman Brothers began in 1844 as a humble dry goods store run by the Lehman siblings in Montgomery, Alabama. Over decades, the business evolved into commodities trading, then into a brokerage firm, and finally into an influential investment bank. It endured numerous challenges, including the Great Depression and the long-term capital management crisis, but prospered after the Glass-Steagall Act was repealed in the 1990s. This repeal allowed commercial banks to enter investment banking activities, fueling Lehman's expansion and profitability. By 2007, it was the fourth largest investment bank in the United States, posting record profits over $4 billion. During the early 2000s housing boom, Lehman Brothers aggressively expanded into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. It acquired several mortgage lenders and securitized about $146 billion worth of loans in 2006. Many of those loans were Alt-A or subprime mortgages granted to borrowers with little documentation. These strategies appeared profitable as housing prices rose. The firm's stock peaked at $86.18 per share in February 2007, giving it a market capitalization of around $60 billion. However, the success masked a dangerously high leverage ratio, 31 times its equity, and an enormous $85 billion mortgage portfolio. When the U.S. housing bubble burst and defaults began to spike in 2007, Lehman's mortgage assets plunged in value. Management delayed selling these risky assets, and consecutive quarterly losses began to erode confidence. By August 2007, the credit crisis was spreading, and the near collapse of Bear Stearns signaled severe instability. Lehman's shares fell sharply. In March 2008, its stock price dropped nearly 48%. Despite raising capital through preferred stock and seeking a strategic partner, the firm's finances deteriorated further. It relied heavily on short-term repo loans to fund long-term assets and increasingly resorted to accounting tricks like Repo 105 to move liabilities off its balance sheet. As the crisis worsened, investors fled. Credit default swap spreads on Lehman's debt spiked, hedge funds pulled money, and banks refused to roll over short-term loans. Over the weekend of September 13 to 14, 2008, last-minute negotiations with Barclays and Bank of America to find a buyer failed. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It held $639 billion in assets and $619 billion in liabilities. This was the largest corporate bankruptcy in U.S. history and sent shockwaves through global financial markets. The Dow Jones Industrial Average dropped roughly 500 points, and runs on money market funds ensued. Barclays and Nomura eventually purchased portions of Lehman's operations, but the sudden failure added to the panic. The Lehman collapse became the pivotal moment of the 2008 financial crisis. Analysts identify several factors and responsible parties in the downfall. First, Lehman's senior executives pursued aggressive growth and excessive leverage, ignoring warnings about the housing market's fragility. The firm continued to accumulate subprime mortgages and overlooked emerging risks. Second, investors relied heavily on credit rating agencies, which assigned high ratings to mortgage-backed securities that proved to be risky. Third, deregulatory policies, including the repeal of Glass-Steagall, removed barriers between commercial and investment banking, allowing Lehman and peers to take on more risk. Fourth, regulators lacked oversight tools to monitor and resolve the failure of non-bank investment firms, leaving them unprepared when panic set in. Fifth, compensation structures at Wall Street firms rewarded short-term gains and encouraged excessive risk-taking. Finally, Lehman manipulated its financial statements using Repo 105 to hide leverage and create a misleadingly healthy picture. Could this crisis have been avoided? Experts argue that earlier recognition of housing bubble risks, stronger capital requirements, and stricter regulatory oversight could have forced Lehman to scale back its mortgage exposure and leverage. For instance, more stringent risk management within Lehman might have curbed its appetite for subprime loans. A robust legal framework enabling regulators to wind down failing investment banks in an orderly fashion could also have prevented the disorderly bankruptcy.